Welcome everybody to Stock Talk with Nico Kritikos. Today we're going to be going through all the typical signs and indicators of a recession that's going to happen, and we're going to do just kind of an analysis on the current economic conditions. So I made a PowerPoint here, and the things we're going to go through are inflation, wages and unemployment, consumer savings, the housing market, stock market valuations, the current bond yield inversion, some commodities, and then the supply chain. So the first thing I want to bring up is inflation. Inflation has caused a lot of problems over the last year or two. It's caused a lot of fear in the markets out there, and it's also hurt a lot of consumers with regular day purchases. But the biggest one has been energy inflation. So gas prices are up 38%, and based off this article I was reading, it says developments in Europe coupled with the ongoing supply constraints, strong demand, and labor shortages will likely maintain inflation elevated for longer. So they're saying that there's no sign of inflation slowing down soon, but I think that with the Fed recently raised rates, right? So we have that, and we have people getting back to work, and we really just need demand to go down more, and we need supply to go up. And that's what I think is going to balance out in the next maybe 3 to 6 months, because people have been getting back to work, and then eventually, demand, as the demand gets as the supply feeds into the demand, then it'll balance out more. But as you can see, inflation is typically 2 to 3%. But over the past year, it's gone from 2.6% all the way up to 7.9% in February of 2022. So this is a very high number, and that's what's causing a lot of the problems out there. But it depends on the market the different commodities and the different markets we're in. It depends on, it affects those markets differently. So for example, how we just saw gas prices are up nearly 40%. And that's a really big one, because or according to this article, they're saying gas is up 51%, but it depends on what region you're in. But I mean, that the inflation put together with the Russia situation that's been happening over the last month or so, that's made the situation a little bit worse. And then, as you can see here, because a couple of weeks ago they said, I think oil peaked out on right around March 8th. I think it hit about almost $130 a share. And that people thought it was going to $200 a share, or not $200 a share, $200 a barrel. I'm sorry. And some people out there still think that it can get to those levels. But I mean, last year oil was right around, I want to say $70, $80, right? And so at right around $100 is still considered high. And that's what's causing gas prices to go through the roof. But lately, the last couple of weeks, gas prices or the oil prices have been kind of balancing out a little bit more. They haven't been as volatile, so that is a good sign. But you have all these other things that affects the consumer, like prices of food and groceries, prices of used cars and new cars was both a huge one. New cars, because of the chip shortage kind of fed into that. But for used cars, and that made used cars prices go up even more. I think they were up about 40% year over year. So all these different things is what is hurting the consumer so much. And then we get to wages and employment, which helps, kind of combat this, kind of fight back against inflation and supply chain issues. And so if we look at the average United States salary, it's roughly $57,000. And the average wage is $31 an hour, which is up 6% year over year. So that is it's a good sign that it's up. But at the same time, if we think about inflation was up 7.9% year over year, then that 6% is still, it's not really doing much against that 8% inflation. So if we can get inflation back down to a 3% level, I think they're aiming to accomplish that in the next 2 years or so. So the rate hikes should keep coming for the rest of 2022. And then we need that inflation to get back down to about a 3% level. And then those higher wages will help, right? Then it'll make a difference. But over the last 100 years or so, unemployment is typically about 5.7%. That's the historical average. And right now we're at 3.6%, which is super good. This is how it was right before the the pandemic started, like in 2019, early 2020, unemployment was right around 3.5, 3.6%. And this is pretty much as low as it can get. You know, a lot of economists say that it normally hovers around that 5 to 6%, but it can't go too much lower. You know, right around 3% is pretty much the low as it can go, because there's always going to be some degree of unemployment out there. So we're at great unemployment levels, even though you still see tons of businesses hiring, and they're trying to do whatever they can to hire more people, get people interested, give bonuses and all that stuff. But unemployment is good. The salaries and wages are up, not as up as not as much as inflation, but still it's a little bit better. It's headed in the right direction. So then that brings us to consumer savings rates. And here we see what I wanted to show here was what the consumer savings rates look like prior to a recession. So let's say we had a recession in 2001, right? So that's right here. And as you can see, the savings rate dropped down to almost 4%, right? So I think 4% is when it starts to get dangerous. I think that's when it's not in a healthy position anymore, because typically it's around 6%, and 6% is like 6% is about your average, right? Maybe 5.5%, 6%. That's like the healthy place you want to be in, if not more. Of course, you want to be a little bit more if possible. But so then we have this recession here in the tech bubble, right? And you could see savings went as high as 7%, and then they came back down to almost 3%. Then we have right before the the financial crisis of 2008. You can see it came back down here. It got really low around this 3 to 4%, and then we had our huge we had the bubble burst, and then things changed. So now if we get to where we are today, we can see that savings rates, of course, during the pandemic, everyone was stuck at home and they had a bunch of money, and they didn't have the things that they could normally spend it on. So that's why we saw, I think savings rates went up to 25% at one point, I think in 2020, but earlier last year it was 12.6%. And since then it's been cut in half. And now we're at about a 6% rate. So looking historically, 6% is where it's healthy. That's more on the higher end or so. And so I'm not worried about the 6% mark. I think the 6% mark is fine. If it was to go below, let's say it goes to, if it keeps heading down, and let's say we get to 5% and then 4.5%, then it's going to be a problem. If we're at 4.5%, that's a very low savings rate. That's not a good thing to see. Then we have the housing market, and this is pretty much follows the same thing as all the other commodities and inflation and supply and demand, all that. So for this past month, we had, for the month of March 2022, existing home sales were 6 million, down from 6.5 million in February of 2022. So it's coming down a little bit. And then a year ago in this time, it was 6.2. So it's decreasing just a little bit, right? And then we have new home sales of 772,000, down from 788,000 the prior month and 823,000 a year ago. So both existing homes and new homes, the sales are both slightly decreasing. And I think that's how it should be, because the market has been so pushed up. And I know there's lots of demand out there, but that's why you see so many houses being built and so many people moving. So I think it's about time that the prices came down, demand came down, and that's what these higher prices have done. They pushed down demand. So the median sales price for a house is now $408,000, which is up 14% over the past year. A year ago, it was $358,000, and that's still a lot, relative to where it was prior. But now we're at 408,000, and so the prices are still up, and the prices are up so much, and that's why that demand is falling. And then we also seen mortgage applications are also decreasing, so less people are interested in buying a home, and I think that's a good thing. I mean, that's just how supply and demand works. So then we have the stock market, and the main thing here is the valuations. Okay, so large cap stocks, this is that chart at the top right here. This one is you can see their trade. This is forward PE ratios, okay, of S&P 500 stocks. So these large cap stocks are trading. They were trading at 22 or 23. Now we've come down to about a 19 or 20, so a little bit better. But still, historically, you can see they normally trade at about a 15, right? 15 or 16 is the historical average. So we're still elevated there. Mid caps are down. Mid caps are in a, they're, if anything, they're undervalued, and then small caps are especially undervalued. As you can see, this is over the past 20 something years. Small caps rarely get to a forward PE ratio of 14, and this is what we're at now. It hit this in 2018, 2015, 2011, and 2008. So it very rarely comes to these levels. So I think small caps deserve to come up. I think there will be money that flows into small caps this year. And then I think the large cap stocks, there'll be like a flip. There'll be a rotation where the money from large cap stocks, because I think that really came, as you can see, when the pandemic hit in 2020, that's why all that money piled into those bigger companies, the safer companies, the especially big tech. So like Microsoft, Google, Apple, those definitely got a big boost from that. And then also companies like Deere, just anything that was seen as safer or larger companies that didn't have to worry about interest rate hikes and stuff like that. That's where the money flowed into. But now things are changing, and I think we're going to see a rotation there. So then on the right here, this is a list of all the times the NASDAQ fell over 10% in the last 11 years. And as you can see, the average is a 16% drop, and it normally lasts for about 60 days. Well, this last one we just had that ended on March 14th lasted for 115 days, almost twice the average. And the NASDAQ dropped 21% over these last couple months, right? So that's another thing that makes me, I don't know how much further down these stocks can go because of what we've already went through so far. And the other thing was Elon Musk tweeted, this was a while ago. He said his gut feeling is that there will be a recession around spring or summer of this year, but not later than 2023. So that's kind of interesting, because if he's saying that, then that means, he's probably someone who knows what he's talking about. And so there's probably a good chance that it could happen. But the other way I like to look at it is, let's say I kind of been wondering, is it possible to have a recession in the economy and have the stock market still not fall a bunch? So the stock market does not directly reflect how the current economy or how businesses are operating. It's delayed by a couple of months, right? Because the stock market is more so a reflection of the consumer, or not the consumer, but the investor sentiment, right? So it's more like the stock market, the current stock market prices are pretty much telling you how investors feel about the upcoming quarters of the businesses, right? That's more of what it is. It's not so much like let's say when the stock market bottoms, it doesn't mean that's when the economy was the worst on that day. It doesn't necessarily correlate like that. So that's the only thing. That's why I kind of think maybe we can have it. Maybe we can have an economic slowdown or recession, and maybe the stock market crash will not be at the same time. So we just went through a huge crash, and it's possible things go down more. But with some of these big companies, like if you look at Netflix and Meta, and some of these are huge companies that have fallen 50%, right? And there's other companies that have fallen 70, 80, even up to 90%. So it's like, how much can you look at PayPal, for example? It's like, how much can these stocks really go down? I think that, it's possible they fall more, but can PayPal go down 90%? I don't know about that. I don't think PayPal is going to trade at a $5 billion or $10 billion valuation. So I think there's only so much these stocks can fall. The next, and then the last thing is the supply chain. Of course, the supply chain is just another, symptom of this whole thing, another root of the problem here. And especially the chip shortage caused a lot of problems. And then, of course, you heard a lot of companies complaining about transportation and logistics. I think the prices of freight and just, shipping stuff, it went up so much. I want to say it at least doubled. I think in some cases, I think it 4x'd in price. And so, that definitely hurts companies' profits. But we have earlier this year when Apple reported earnings, Tim Cook said that things are getting better. So, you have some companies giving more positive guidance like that. And, I think things will balance back out. And then once they can produce more chips and stuff, then that will solve a lot of the problems. So in conclusion, we have inflation is really bad right now, but the Fed is fighting it with rate hikes. So that's good. We have high employment, which is, well, I put high employment and GDP growth will help combat that inflation, right? Because we need supply up, demand down. We need people to work more. And then we need demand needs to slow while supply needs to grow. And then I put savings rates are healthy, but need to stay roughly about 6% or more to remain in a strong position. I feel safe. I like when it's like 8% or 9%. I think it's safer like that. But, people like to spend money. Then we have a housing market that's super hot right now, but it's starting to slow down because of those high prices is pushing down demand. So that's good in a way. We need people to be able to afford houses. But once again, that comes back to saving your money and working to make more money. And especially the most important thing is the GDP or just manufacturing and producing things. That's how you grow supply and that takes care of the high demand. Then we have stock market. Small cap stocks are at record lows. Big caps are slightly overvalued. So I think there's going to be a switch there. I think a lot of money could come out of Apple and Google and Microsoft, and then come back into some of the smaller companies, maybe the tech stocks or the startups, the unprofitable companies. Then I put the recent correction that we had, which lasted 115 days, and the NASDAQ went down 22%. Definitely put the market in a healthier place. And with many stocks down over 60%, how far can they really go down? What's realistic? I mean, I don't know if it's realistic to see Apple fall 60% or even PayPal has already fallen, 50, 60%. So is it possible it goes down to 85, down 80%, or is it possible it goes down to $10 a share? I don't really think so. That's why I think the downside is very limited here. And then we have the yield inversion. This is, do we go through this? Let's see this is, I didn't bring this up, but okay. So this is the bond yields, right? This is the 10-year and the 2-year treasury yields. Okay. And what we're looking for here is, you can see every time it inverts, okay, there's a recession within I want to say under 2 years. I want to say within a year to 2 years, there's a recession. It's very consistent. So 1991, we have an economic slowdown, and the yield inversion happened right here in 1989, right? Then we have the 2001 recession or the crash. And 2000, of course, we had the yield inversion. 2007 yield inversion followed by the 2008 crash. And then 2019, we had this inversion, but then we had the drop, and we had the COVID pandemic start. And I think that really threw things off. So I think and then right now we have another inversion. It just inverted a couple of weeks ago. And so now we're back at this level. And so this is very convincing that there's going to be some sort of recession or crash soon. What I'm wondering though is, can we have that recession this year, but still not have the stock or still have the stock market, or still the stock market remains somewhat up, or I don't know how much it can go up, but maybe it doesn't fall that much. But yeah, so that's very interesting. We had one in 2019, then we had our COVID pandemic, right? And that probably really threw things off. We had a huge, bull run in the stock market, but now I think things are getting back to normal, and they're kind of catching back up with us, and we're back to that 2019 level where we have that yield inversion, and then it looks like it's time for a recession. But I like to be optimistic, so a lot of these things I like to point out, that make the economy look good. But if we're being realistic here, it's very possible that it happens. Then we have a supply chain disruption, but I put high employment and GDP growth will fix that. And that is pretty much it. Those are all my points and all my thoughts on a possible recession happening this year. So yeah, let me know what you guys think. Comment down below. I'm curious to hear your guys' thoughts. Thank you for watching, and I will see you in the next video.